Hello everyone, here are the latest market news on July 28, 2020. Samsung shares rise amid Intel outsourcing plan. South Korean chipmaker Samsung Electronics showed on Tuesday its shares rose significantly, joining its rival Taiwan Semiconductor Manufacturing Co. Ltd. amid growing expectations that the companies may benefit from Intel Corp's plan to outsource more chip manufacturing. Samsung Electronics stock surged 5.8% to their highest level in about 5 months and were on track to finish higher for a third consecutive session. Shares of TSMC also marked gains on Tuesday, jumped 5% after hitting a record high on Monday. With a market value of 11.66 trillion new Taiwan dollars, $398 billion, TSMC has a higher market capitalization than Samsung Electronics, a diversified tech giant which is valued at 369.18 trillion won as of Tuesday. ECB prolongs limitations for regional banks. On Tuesday, the European Central Bank announced a decision to prolong the prohibition for regional banks to pay dividends and buy back their own stocks from October to the end of the year. According to Andrea Enria, chair of the Supervisory Board of the ECB, this move came alongside an assessment of the potential vulnerabilities of the euro area banking sector in the wake of the coronavirus. Overall, the Euro Stoxx Banks Index has already lost 34% this year, surpassing the 12% drop for the broader Stoxx Europe 600 benchmark. Chinese travel giant Ctrip delists from Nasdaq. Chinese online travel giant Ctrip started talks with potential investors about funding companies delisting from U.S. stock exchange Nasdaq. The management of China's largest online travel firm, with a current market value of $16.5 billion, has appealed to financial and strategic investors, including private equity firms and domestic tech companies, asking for joining a take-private deal. Ctrip, also known as Trip.com Group Ltd., followed the other Chinese companies which were delisted from U.S. bourses due to facing tightened scrutiny and stricter audit requirements for U.S. regulators amid geopolitical tensions between the world's two largest economies. U.S. government asks FCC to revise Section 230. The U.S. authorities continue to work and plan to regulate content on social media platforms, this time formally asking federal regulators to start overseeing how these networks handle user-generated content. The Commerce Department called the Federal Communications Commission to reinterpret key elements of Section 230 of the 1996 Communications Decency Act, which has given online companies broad immunity from legal liability of their users' actions and content. The decision followed campaigns by President Donald Trump and other politicians who claim left-leaning Silicon Valley technology companies unfairly censor conservative views of their digital platforms.